In decentralized finance, liquidity provision is often described as passive income. Deposit 2 tokens. Let traders swap, collect fees. But that description leaves out the most important part of the trade. A liquidity provider is not just earning a fee stream. A liquidity provider is making a market against the world. And when the market price moves before the pool price moves, someone gets to trade against a stale quote. That someone is usually an arbitrageur. This video is about the hidden cost behind automated market making, loss versus rebalancing, or LVR. It is not the same as impermanent loss. It is sharper, more mechanical, and in many ways more honest. Start with the simplest AMM, a constant product pool. Instead of an order book, the pool holds 2 assets. Call them X and Y. In a Uniswap-style constant product AMM, the pool tries to preserve the invariant, X times Y equals K. If the pool has 10 ETH and 10,000 USDC, then K is 100,000. The implied price of ETH is Y divided by X, or 1,000 USDC per ETH. This looks clean, but it has a crucial consequence. The pool does not know the true market price in real time. It only knows its own reserves. The outside market can move first. The pool moves only when someone trades against it. Now, let the outside price of ETH jump from 1,000 to 1,210. In this clean no-fee example, the mechanism is easiest to see. For a moment, the AMM is still quoting the old price, so an arbitrageur buys ETH from the pool and pays USDC into the pool until the pool price catches up. In a real pool, swap fees would change the exact P&L, but not the stale quote mechanism. After the arbitrage, the pool holds about 9.0909 ETH and 1,000 USDC. At the new market price, the LP position is worth exactly $22,000. But if the liquidity provider had simply held the original 10 ETH and 10,000 USDC, the portfolio would be worth $22,100. The gap is $100. That $100 did not disappear by magic. It is the profit created by trading against a quote that was stale relative to the external market. This is the first intuition for LVR. The AMM sells the asset that just became more valuable before it knows that it became more valuable. Here is the trap. If the ETH price returns from 1,210 back to 1,000, the classic impermanent loss number goes back to 0. The pool ends where it started. The hold portfolio also ends where it started. So a beginner might say, no harm done. But the arbitrageurs traded twice. On the way up, the arbitrageur extracted $100. On the way back down, the arbitrageur extracted another $90.91. The final price is unchanged. The impermanent loss is 0. But the path still created roughly $190.91 of value transfer away from the pool. That is why LVR is more than a prettier name for impermanent loss. Impermanent loss is a comparison at the endpoint. LVR is a comparison along the path. The formal benchmark is simple. Imagine a rebalancing strategy that always holds the same risky asset inventory as the AMM. If the AMM ends up holding less ETH, the benchmark also holds less ETH. If the AMM buys ETH back, the benchmark buys ETH back. But there is one difference. The benchmark trades at the external market price. The AMM trades along its own curve. Loss versus rebalancing is the value of that difference. It asks, compared with a portfolio that rebalanced into the same inventory at fair market prices, how much value did the AMM lose by being picked off at stale prices? In the clean no-fee model, LVR is the adverse selection cost. In a real pool, the LP receives fees too. So the simplified economic equation becomes LP performance after hedging market exposure is approximately fees minus LVR. That is the whole episode in one line. The remarkable result from the LVR literature is that for a 50-50 constant product AMM, under a clean continuous time model with no fees, the LVR rate per dollar of pool value is approximately 1/8 of instantaneous variance. In symbols, LVR divided by pool value equals sigma squared divided by 8. This is not a forecasting formula. It is a local model under assumptions. but it reveals the mechanism. Volatility becomes a bill. If daily volatility is 5%, then sigma squared divided by 8 is 0.05 squared divided by 8, or 0.003125. That is 3.125 basis points per day. On a $1 million pool, that is about $312.50 of LVR per day, before fees, gas, incentives, active rebalancing, and all the messy details of real markets. If the daily volatility were 2%, the number is only half a basis point. If it were 8%, it becomes 8 basis points. The cost scales with variance, not volatility. Double volatility, and the bill roughly quadruples. Now add the other side, fees. Fees are not fake. They are real cash flows paid by traders, mostly or partly accruing to active liquidity providers after any protocol fee were enabled. At the time of research, DeFi Llama listed combined Uniswap TVL at about $3.862 billion, 24-hour DEX volume at about $1.329 billion, cumulative DEX volume at about $3.66 trillion, and annualized fees from the current 24-hour run rate around $484.5 million. So the question is not, do LPs earn fees? They do. The question is, are the fees enough to compensate for inventory risk, gas costs, active management, and adverse selection? A simple gross fee approximation helps. A 30 basis point pool with daily volume equal to 10% of TVL generates about 3 basis points of gross swap fees per day before protocol fees, gas, and other costs. But at 5% daily volatility, the clean constant product LVR estimate is 3.1125 basis points per day. A 5 basis point LP fee share with the same turnover generates only half a basis point of gross fees per day. So the answer is regime dependent. High volume and low volatility can make fees powerful. High volatility, low fee tiers, stale execution, or narrow ranges can make the hidden cost dominate. Uniswap v3 made the problem more interesting. Instead of spreading liquidity from 0 to infinity, LPs can concentrate capital inside a chosen price range. This can dramatically improve capital efficiency. In stablecoin pairs, for example, the old full-range design used only a tiny fraction of capital near the price range where most trading occurs. But capital efficiency is not free. When liquidity is concentrated, the LP is taking a more leveraged market-making position over a narrower interval. The position can earn more fees per dollar while it remains in range, but it can also stop earning fees when price leaves the range, and it can accumulate one asset as price moves in one direction. The LVR paper makes this point mathematically. For a range order, the absolute instantaneous LVR can be similar for the same marginal liquidity, but the pool value deployed in the range is lower. As the range becomes extremely narrow, LVR per dollar of reserves can become very large. That does not mean concentrated liquidity is bad. It means it is not passive. It is an active market-making design. The empirical literature is not one-sided, and that is important. One early study of Uniswap v3 analyzed 17 pools covering 43% of TVL in its sample. It found total fees of $199.3 million, but total impermanent loss of $260.1 million over the studied period. In aggregate, those LPs would have been better off by $60.8 million simply holding the assets. That is not the final word. It is an early period sample. It measures impermanent loss rather than LVR, and Uniswap v3 strategies have evolved. A later empirical study looked directly at losses to arbitrageurs and compared them with historical fees across large Uniswap pools. It found that fees were insufficient to compensate arbitrage losses across many of the largest pools, and that less capital-efficient V2 pools were often more profitable than corresponding V3 pools in that measure. The same study also found that reducing block time from Ethereum's 12-second scale to 100 milliseconds reduced arbitrage losses by roughly 20 to 70%, depending on the pair. But there is nuance in the other direction, too. A Uniswap Lab study found that many non-rebalancing V3 positions generated higher fee returns than comparable V2 positions. Both statements can be true. Fee returns can improve while total risk-adjusted LP profitability remains difficult. The gross fee stream is not the same as the net market-making trade. So the honest equation is not LP equals passive yield. The honest equation is closer to this. LP economics equals fees minus LVR minus gas and rebalancing costs minus opportunity cost plus or minus market exposure plus or minus incentives. Sometimes the fees can win. Sometimes incentives can change the economics. Sometimes a stable pair with deep volume and low volatility behaves very differently from a volatile token pair. Sometimes active management matters more than the fee tier itself. This is why the word passive is dangerous. An AMMLP is not a bank deposit. It is not a bond coupon. It is not free yield. It is a market-making position encoded into a smart contract. The smart contract does not panic. It does not negotiate. It does not decide whether the next trade is toxic. It simply quotes the curve. And when the world moves before the curve updates, LVR is the bill. The lesson is not that liquidity provision is always bad. The lesson is that liquidity provision is a professional market structure problem disguised as a yield product. Fees are visible. LVR is structural. Net return is the difference. Once you see that, the AMM stops looking like passive income. It starts looking like what it really is: a volatility-sensitive market-making strategy running in public one block at a time. This video is for education only and is not financial advice.